Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Today is going to be a fun video because we're going to go through what really happens when you make a purchase or a sell on a cryptocurrency exchange. What is the actual process that the exchange goes through to conduct that trade? It's a little bit different between every single exchange, but this is the basic principle. Now, first, let's discuss some of the nuances that can't be easily replicated. And that is, of course, the order book, supply and demand. That does have an impact on your actual purchase values. Sometimes you'll get lucky and get exactly what you want. Sometimes, because the market doesn't have what you want, you'll get a little less. And that will affect your values and your holdings over time. We're not going to cover that here just because that will make the mathematics significantly more complicated than what they need to be for the basic understanding of how your wallet really works. So for the purposes of this demonstration, we're going to use the pair ADA USDT. Now that is actually two wallets. That is, we're going to be using the ADA wallet as the base currency or left side of the pair. And we're going to be using the USDT wallet as the quote currency or right side of the pair. It's important to understand the distinction because that impacts and affects how you actually trade and what mathematics get performed on the various components. So let's start out with the basics of how this even takes place. Every order has an ID of some kind. That's how the exchange tracks what you've done. So your order or your trade, in this case they're one and the same, will be issued an ID by the exchange. The date and time it took place, the side or direction. Did you buy it? Did you sell it? What is not tracked is the actual amount you want when you place your order. In this case, for the purposes of this demonstration, I want to purchase 12 ADA. That is important to understand that in my currency pair, I am purchasing the base side, but paying with the quote side. Now we're going to get into each of these as necessary, but for now let's take a look at the basic principle of the quote side. And you'll see that my actual amount isn't 12. And that is because you're going to pay a fee. For the exchange I am emulating in this example, I am using Kraken, which takes a 0.26% fee. That fee comes off the very top of the transaction, right away out of your quote currency. So your fee, in this case, is going to be roughly 0.03 cents. And that is going to be reflected in the actual amount you purchase. Your actual amount is what will be deposited into your ADA wallet. Now it's important to understand that yes, I said ADA wallet. See, the context of a cryptocurrency exchange is that every currency has its own wallet. That's how you can buy ADA BTC and ADA USDT and still get ADA as the primary component, irregardless of your quote side currencies. The product ADA isn't tracked between different quotes. It's only tracked at one base level, one wallet per currency. So ADA USDT and ADA Euro are the same product of ADA. All that matters is the translation of how you pay for it. But the amount that you purchase is still going to follow the same basic process, that the fees are going to come out of your quote currency before you actually get an amount in ADA. So in this case, we have 11.9, and you can see the exact number, ADA. Now, for the purposes of this simulation, we're going to start with a balance of 10,000 USDT. And the USDT is going to be the product of the actual amount of ADA multiplied by the current price, or the real cost of $7 and roughly 42 cents. That value here, the real cost, that is what is subtracted from your USDT. So now that we know how much we've actually spent in USDT, and we know how much we've actually spent, or actually received in ADA, our first transaction is complete. That is, we know the amount that we've actually received, we know the price we've actually paid, and we know the fees we've actually paid. And we have the real cost of what we've actually purchased. Our ADA wallet is given, or it is deposited into the amount that we've actually wanted, 11.9 ADA. And that carries on for every single trade we make. So for the second trade, we purchase exactly the same thing. 12 ADA is what we want, but we're only given 11.9 ADA because the fees are deducted. So we have a total of 23.9 ADA in our wallet, and our budget is adjusted appropriately for our USDT pair, which is currency. Now, as you can see, this is calculated specifically to 8 decimal places. That's important because that's how the cryptocurrency exchanges work. And it's taken me years of actually going order by order, dissecting what is given back from the exchange when you place an order, to actually make sure these mathematics are correct. So as we progress and we see each level, each purchase, we get the context of just what is going on over and over throughout the mechanical steps. And finally, we have a total of 59 ADA. And we get a sell order. Now, that sell order means we're going to sell and close our position in ADA at a given price. Now, we're using an accumulation technique. So that means that we want 1% above average to be our profit. And our real cost that we paid was $36 total. And we made a real profit of 5 cents by closing out the account, or closing out the asset. And what you have left over isn't zero. When you're dealing with a cryptocurrency wallet and transactions, rounding fees or rounding errors take place because of the number of digits versus the actual number the order book translates. You see, the order book itself only records so many digits, not the entire 8. So for some currencies, it might only be 4 digits after the decimal. For others, it might be 6 digits after the decimal. When an order is matched to your request, rounding takes place to fit your purchase into what is available in the order book. And that always means there's going to be a little bit of residue, or what the cryptocurrency exchanges call dust. And that is what is left over here, the dust of the trading. It happens all of the time. So we are left with this dust that when we make our next purchase gets added into the amount that we have. Now the important thing to remember is that as we track our averages, this information is not saved on the exchange. We have to manually track the average. All we see on the exchange are 2 numbers, and that is strictly our wallet, how much we have in ADA and how much we have in USDT for this example. The actual prices we've paid along the way aren't saved by the exchange. They don't matter to the exchange, only to us. So if you use an accumulation approach, you have to track the prices by which you made the purchases. You have to track the real costs of what you actually spent in order to determine whether or not you are really in profit. So now we go to the dust that we have from closing out our position. This dust is then added into our next purchase. And as we can see, it affects the amount and the value. Even though we still want 12 ADA and we're still given 11.9 ADA because of the subtraction of the fees. And you'll notice that you also always deal with fees on selling. That is important. The exchange is going to get its fees first, always. Bottom line, be prepared to pay those fees. They do add up, and you do need to be aware of how those fees interact when you're working with your trading style or approach. So as we continue to see exactly how each position is metered and monitored based upon what we are accumulating in our ADA wallet, we can see clearly as we accumulate and as the wallet decreases for USDT, meaning we are making more and more purchases. Now, if you have more than one asset, say you're trading ADA, Bitcoin, Ethereum, that's all going to come out of one wallet. So your values are going to be significantly more difficult to track in terms of profit and loss. So you need to be aware that these can get very confusing, which is why I am only using one currency in this example. Now again, we hit our 1% take profit, and we should see a nice little wonderful profit. But in reality, we got a loss. And that is because no matter how good your strategy is, you can't predict slippage. And in this case, whatever the price was that I thought I had by the time the exchange executed the order. This is the price I received, and it cost me 52 cents. No matter how good your strategy is, you can't escape the situation of slippage. Slippage can work for you or against you, as it did in this case. You need to be prepared to accept that there is no such thing as a 100% win rate, even with a strategy that doesn't sell unless it sees a profit. Because at the point that this signal was generated, it saw a 1% profit. The profit I set that I wanted, but the actual execution was not in profit. It happens. It's just a part of the system. And now you'll see we have another legitimate profit, and we only took one trade to achieve this profit. So as we continue through, you can see just how well these situations work. And that is the point. Trading is a simple process, and it is profitable if you understand the relationship between the base and the quote currency wallets. If you understand that the exchange only tracks those two numbers, not the actual numbers you've purchased. And that is the critical component of trading. You have to actually track certain things yourself, depending upon the style and method of your trades. It becomes easy to see just how to make money once you understand the mechanical process of the wallet itself. All that really matters at this point is figuring out your technique. Do you use accumulation? Do you use stop loss? Do you use some combination? But either way, no matter what technique you use, the functionality of your wallets are going to be identical. Whatever your quote currency is what you are going to pay in. Whatever your base currency is what you are going to receive. When you make a sell, it is deducted from your base currency and deposited into your quote currency at the current market value. It is a very simple process, but can be very tedious when you actually get into the real world mechanics of supply and demand, meaning how much is available that you can actually purchase at a certain point. Because when you make a purchase, this example that you see in front of you assumes that your entire purchase is at one price. But when you're actually live trading, that doesn't always happen. Sometimes an order will be filled, but you won't receive all of it. So in order to fill your order completely, part of it will be at a separate price. Again, showing the differentials between supply and demand. So while you move forward examining your records, take time to understand the intricacies between your wallets to determine your real-world profitability. Overall, we can see I made a profit, but legitimately speaking, at the end of the day, at the end of this simulation, I'm under roughly 31 cents underwater, given my original budget. That is the true context of whether or not you are profitable. Not just on the individual trades that may or may not be profitable, but on the wallet versus your actual amount you deposited to begin with. Both of these numbers count, and both of them have an impact in relation to your profitability. Yes, you can win and still lose at the same time. So, let me know if you have any questions whatsoever. Share your thoughts. Give this video a thumbs up and like it if you thought it was helpful in explaining how the market really works, or specifically how your wallet works when you buy and sell. Thank you for watching.